Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks, finance, and risk management. I'm your host, Lewis, and I'm excited to have you join us today. We're starting off with a couple of interesting stories from the world of finance. First up, we have an update on the U.S. economy and the potential for Fed rate cuts. According to a recent interview with Matt Orton, also known as Matt Orton, from Raymond James Investment, the latest CPI print may not be enough to trigger immediate rate cuts, but it does suggest that the economy is slowing down. This has led to speculation about when the Federal Reserve might step in to stimulate growth. We'll be keeping a close eye on this story and bringing you updates as more information becomes available. In other news, the State Bank of India, or SBI, has announced plans to raise up to 20,000 crore rupees through the issuance of Basel III-compliant bonds. This move is seen as a positive step for the bank, which has been lagging behind its peers in the ESU banking space. The fundraising effort is expected to help SBI strengthen its balance sheet and improve its capital position. We'll be watching to see how this development affects the bank's stock price and overall performance. It's worth noting that the Indian bond market has been growing rapidly, with a 25% compound annual growth rate over the past decade. This surge in growth has been driven in part by private sector issuances, which have helped to deepen the market and provide more opportunities for investors. As we navigate the complex world of finance, it's essential to stay informed and up to date on the latest developments. That's why we're here to bring you the latest news, analysis, and insights from the world of stocks and finance. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're still with us as we dive into the world of finance and risk management. In this segment, we'll be discussing some interesting developments in the Indian stock market. First off, let's talk about Jaiprakash Power Ventures, or JP Power for short. The company's shares have been on a wild ride lately, sliding over 5% in intraday trade on Wednesday after a nearly 10% drop on Tuesday. This decline comes despite the stock hitting its 52-week high of Rs 27.62 earlier this week. So, what's behind this volatility? Well, it seems that JP Power is currently under the Additional Surveillance Measure Framework, which is a regulatory measure aimed at controlling excessive volatility and protecting retail investors. The stock has also been affected by reports that the Adani Group has submitted a bid to acquire the debt-laden Jaiprakash Associates, a company linked to JP Power via a corporate guarantee. Now, let's take a step back and look at the bigger picture. The Indian stock market has been experiencing significant fluctuations in recent times, with many stocks seeing sharp increases and decreases in value. This volatility can be attributed to various factors, including global economic trends, regulatory changes, and company-specific news. As investors, it's essential to stay informed and adapt to these changing market conditions. It's also crucial to maintain a balanced portfolio and not put all your eggs in one basket. Diversification is key to managing risk and maximizing returns. In other news, the Reserve Bank of India is reviewing its foreign direct investment policies, which could have significant implications for public sector banks. We'll be keeping a close eye on this development and providing updates as more information becomes available. And finally, let's touch on the story of Mumbai International Airport Limited, where a group of lenders has approached the Bombay High Court to halt the company's proposed rights issue. This move is seen as an attempt to prevent the company from raising funds that could potentially be used to repay debts owed to these lenders. As we can see, the world of finance is complex and multifaceted, with many moving parts and competing interests. At the Riskwiser Zone, our goal is to provide you with timely and insightful analysis, helping you navigate these complexities and make informed decisions. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the closing segment of the Riskwiser Zone. Today, we're going to dive into the world of banking and finance, as two Wall Street giants, Goldman Sachs and Bank of America, are set to report their second quarter earnings. Now, I know what you're thinking. Louis, why should I care about bank earnings? Well, my friends, these reports can give us valuable insights into the overall health of the economy and the financial sector. Let's start with Goldman Sachs. The street expects the company to report earnings per share of $9.53 and revenue of $13.47 billion. Now, that's a pretty penny if I do say so myself. But what's driving these expectations? Well, it seems that Goldman's trading desks have been benefiting from the market volatility caused by President Trump's tariff policies. And let's not forget about investment banking activity. Mergers and debt issuance have been exceeding expectations, thanks to a sharp rebound in asset values. But here's the thing. Goldman Sachs is heavily reliant on Wall Street activities, which can be a double-edged sword. When markets are booming, they can reap huge rewards. But when things go south, they can underperform. So it'll be interesting to see how they navigate these choppy waters. Moving on to Bank of America, the expectations are a bit more modest, with earnings per share expected to come in at 86 cents and revenue at $26.72 billion. Now, one thing that caught my eye was the expectation of a roughly 23% decline in investment banking fees. Ouch! That's a pretty significant drop. But on the other hand, analysts are expecting net interest income to rise, which could be an inflection point for the bank. Now, I know some of you might be thinking, Louis, this all sounds like a lot of financial mumbo-jumbo. And you're right, it is. But here's the thing. These banks are bellwethers of the economy. They're like canaries in the coal mine, if you will. So, when they report their earnings, it gives us a glimpse into the overall health of the financial sector and the economy as a whole. So, what can we take away from all this? Well, for one, it's clear that these banks are still heavily influenced by market volatility and economic trends. And two, despite some challenges, they're still managing to eke out profits. But, as always, it's essential to keep things in perspective and not get too caught up in the short-term noise. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution. Don't forget to do your research, diversify your portfolio, and always keep a level head. And most importantly, stay informed and stay vigilant. Until next time, farewell and happy investing.